Underwriting deals is such a major pain point for people. Most don't want to do it, and the people that are good at it are few and far between. That is why after 6 years of being in the industry and buying over 1,200 apartments, using my best-selling multifamily deal analyzer, I created Real Estate Lab, a full suite acquisition software for multifamily investors. We have built a product that helps investors automate their acquisitions and close more deals, all in a cloud-based platform. You can go to realestatelab.com and sign up today using the promo code TAG2 for 10% off your first 12 months. This is David Tupin. Thanks for listening.
Welcome to The Apartment Gurus, where twice a week, host Tate Siemer brings you deep dive interviews with the wisest gurus in the apartment investing industry. These experts are sure to create game-changing value and inspiration designed to catapult your business to the next level. Be sure to reach out to Tate at www.investwithgreenlight.com for access to his investor portal and Calendly link. And now, here is Tate Siemer and the Apartment Gurus.
Welcome, everybody, back. Another episode of the Apartment Gurus is on the way, coming at you right now. And I'm excited today to have my friend Bruce Wuollet on the show. Bruce is with the Bakerson Company. Is that what do you call it officially? Just Bakerson or Bakerson?
Bakerson.
Just Bakerson. It's just like Prince. It just needs one name, right? It's such a big deal. I got it. And basically, Bruce has been working with Bakerson for 19 years, mostly in the multifamily space, but does have a long track record. He's done over 2,000 single family residents that he's transacted on. And he's done over 968 multifamily units in his career. Currently, they have 97 units in their portfolio. And he's coming to us from sunny, hot Arizona. I'm assuming it's still pretty hot down there. It's hot up here in Salt Lake City. And when it's hot here, it's really hot in Arizona. So, but Bruce, I'm really glad to have you on the show and welcome.
Thanks, Tate. I appreciate being on here. And we've, I guess I got to update my bio because we picked up some properties this year at 253 units.
There you go.
We had over 500 and then we sold them in 2019, 20, and then regrouped 21, 22, and made the transition. But I'll get in that in a little bit. But yeah, sure. And I was just in Salt Lake for Labor Day weekend, and it was 103 there, and it was 103 in Carefree. So we were the same. But yeah, I went up there to cool off. It didn't work. Actually, it did. I went up into the mountains. We did some hiking at 9,000 elevation. It was in the 70s. It's gorgeous.
Where'd you go hiking?
Oh boy, you're gonna Francis Peak.
Okay.
And Thurston Peak, and one other one. We did 3 peaks there.
Okay, I'm not familiar with either one of those. That they're close to Salt Lake, huh?
Yeah, they're just east of downtown Salt Lake. Yep.
Okay. Well,
about an hour and a half drive up the mountain, but it's up a dusty dirt trail. 13 miles of single track or dual track road up in a 4-wheel drive.
Were you up in the Uinta Mountains? Does that sound right?
I don't know.
Okay.
It could be.
Those are the
right
mountains.
To the east.
Yeah, those are the mountains that are east of the Wasatch Mountains, which are the ones right next to Salt Lake.
No, this is in the Wasatch. We were in the Wasatch Mountains, the ones just overlooking the city. We got to the top, we could see Salt Lake. Yeah.
Okay. Very, very cool. Well, if you would please just kind of share with the listeners and myself a little bit more about you, Bruce, and kind of your story. You've been with Bakerson for 19 years. That's a long time, long track record. And you don't look very old, so you must have started way young. But if you could kind of just share with us, some of the key events and happenings along the way that kind of got you where you are today, that'd be great.
Well, that's why I grow the gray beard, so I get a little respect because I got this baby face. Yeah, I've got in January grandchild number 14. So I've
whoa, that's amazing.
My wife and kids in this picture right behind me there.
Yeah, nice.
6
Yeah.
kids. So yeah,
Those-
but yeah, that's my motivation every day to get up and go to work. So yeah, I grew up in the bakery business in the Minneapolis, St. Paul, Twin Cities area. And that's where the name Bakerson comes from. I tell people I've always been an SOB, a son of a baker. And so then I grew up in the bakery business, tried my hands there, and then I got into executive recruiting. And then from there, moved from Minneapolis to Chicago. And then I moved to Phoenix, worked for a medical device company, and then did that for a year. It didn't go as I wanted. I didn't like that kind of sales so much. And then I got into drug education business with a drug detective from the city of Phoenix. Did that for a year, broke even on that after 1 year, and thought, well, I got to do something different. So then my friend Gary was doing tax lien foreclosures, and that would have been in 2000. And so I started getting at tax lien foreclosures and helping him buy properties. I was a small partner in his business. And then I found out there was other ways, read Rich Dad, Poor Dad, and learned about using other people's money. Said, hey, I can do that. I know people with money. So then started buying some rentals in 2002. And then in October 2002, so we're almost on the 20th anniversary of Bakerson, October 4th, 2022 will be our 20th anniversary in business. So I bought some houses, had some rentals, and did that for 6 or 8 months, and I got introduced to wholesaling. No, it was probably longer than that. 9 months, they got introduced to wholesaling. Started wholesaling properties in December of 2002. And then 2003, we sold 60 something properties and 47 to one buyer. And so I was really like, okay, this is fun. I can do this. And so we became kind of wholesaling before wholesaling was really a thing. Early 20 years ago, there was people had no idea you could flip a house. And I was flipping contracts. It's all under contract law. Did some buy, fix, and sell. Did some retail as well. And did over about 2,200 homes here all in the Phoenix metro. And then when the market shifted and it was really, really hard to buy houses, we got into multifamily, started wholesaling multifamily, flipped a couple dozen contracts, 23, 24, 25, somewhere in there. I don't know the exact count, but in the 20s, where we were able to flip apartments. And then these people came to us and said, hey, why don't we take this one down? And I looked at it, and it was 120 units, 34 plexes on 10 acres. And I said, okay, I've done a fourplex. Okay, we can do, it's just 34 plexes. So I broke it up into a spreadsheet. Each fourplex had 4 units, of course, and then just broke it down and said, hey, okay, this thing makes a ton of sense. Let's do it. And then we bought a 64 unit, actually bought the 64 unit first, and then the 120 unit, like right after, like within a couple of months.
Those were the first two multifamily. Yeah.
Yep.
Gotcha. Okay.
And so then we did 6 projects in Phoenix. And then I said, you know what, it's getting too hard to find deals. And so I went down to Tucson, bought 11 projects in Tucson, and did really well on those. And then we flipped out we exited Tucson. And then we have one down Southern Arizona by the border. It's a motel conversion to apartments we're wrapping up here. And then we have one building in Albuquerque, and then we have a building in Fort Worth. And Dallas-Fort Worth is really becoming where we're finding some good deals. We made offers there for 7 years, and we got our first deal, which is 152 unit. That's doing quite well. Bought that in May, and it's doing quite well. And so we were looking at we're going into contract here this week on a 62 unit there, and then we've got other assets there that we're eyeballing. So it looks like a good market for us to buy C properties and really focus on turning those around. It's a big market there.
Yeah, it's a huge market. It's also a very hot market for doing what we're doing. People love to buy commercial assets in Dallas-Fort Worth and that MSA. So are you finding that first of all, do you model your deals as cash flow deals typically, or are your deals? Yeah. Go ahead.
In the past we had buy, fix, and sell with the intent of just capturing quick profits, turning the property around in 18 to 24 months, maybe even 36 months. But what I found out is that every time we sell a property, I'm out of work, and I was getting my son was like, we got to buy properties that we can hold long term, get some cash flow. And So we changed our business model. Now everything we buy is going to have cash flow, and it's going to be legacy with no sale date in mind. We plan to refinance out within the first 5 to 7 years, or 3 to 5 years, and get all of our capital out based on cash flow, and then go buy the next one. And be into each deal with over time, any 5-year period, we should be able to refinance out somewhere all of our capital. And continue to cash flow. So yeah, we're buying cash flow, and it's a lot of work to find cash flow now.
Right.
The last few months with rising interest rates, a couple of deals landed in our laps. Nothing we did magical besides hard work to find those, but it looks like they're promising to find cash flow deals, just because the mortgage rates are creeping up, and a lot of people still have expectations for 10 months ago what they could get, and
right.
They're holding out. And if they can hold out, they can hold out. We'll see interest rates go up and down. They'll probably be down again next year. But between now and then, I'd like to pick up some assets below market. So we'll see if we can find them.
Yeah. Yeah. So, for listeners, couple big key takeaways there. If you're buying stuff that cash flows, you're kind of, you're mitigating so much risk in terms of your exposure to the immediate market cycle. If you're buying stuff on appreciation and speculation that you can, turn it and burn it kind of thing, it's just like single family, really, where the market shifts during your hold time, and things change with interest rates or cap rates, or the economy, and rents, flatten out or whatever, and you can't raise rents. You're stuck with a property that doesn't cash flow, and that is gonna be very challenging to service as far as debt and whatnot. And so our strategy at Greenlight, and sounds like your strategy, Bruce, now with Bakerson, is to buy cash flowing properties, and buy properties that cash flow in place or very close to in place, with the idea that you're still doing a value add, you're still improving, you're still repositioning, probably, but you're doing so with a solvent asset. Basically, you've essentially bought a business that is breaking even. It's in the black. It's doing what it needs to do to pay the debt service, to pay all of its expenses, and to pay the investors that have invested in the property. So, when we talk about the anxieties of the immediate market and inflation and interest rates going up and whatnot, like if you're modeling stuff so you can keep it for 3, 5, 7 years, like what Bruce is talking about, at least, and either selling or refining after that point, you're going to be projectably riding out whatever rough waters we have here in the near term. So, it sounds like we've arrived at the same basic kind of model, Bruce, as far as, how to go about things right now, how to keep moving, how to keep your feet moving under you, as a running back, so to speak. And to keep doing deals throughout this shift. I think that's really the magic code, is the cash flow thing.
Yeah, we're finding that same. So and the other thing is, lenders are being a little bit more bearish on their lending. So we're seeing 65-70% loan to value kind of at the peak.
Right.
Now, you can get some bridge product for more, but as far as permanent long-term financing, you're looking at a pretty good down payment. And buying bridge right now can be difficult with a floating rate, because it can be quite expensive to buy down the rate, and uncertainty of where it's going. You might have to have a rate cap, which is not the same as a cap rate, but rate cap, we have to buy insurance to cap your interest rate. Lenders will require that because they don't want the property. They want the money working. So you buy an insurance policy on that. Right. So there's some of those challenges. And then as far as if you buy cash flowing, one of the challenges that you're going to run into, and I think your listeners be aware of this, is you want to keep it cash flowing, so you can only turn units as people move out. Because if you vacate them,
right,
vacant units pay no bills. So we're trying to keep our property, that one we have in Fort Worth, over 90% occupied. So there's 12 vacant units now, 6 are just completed. Vacant, they're ready. And at any time, we're trying to keep it no more than that. Well, it's difficult to time it just right with all the, getting the workers there, getting supplies. There's still a few supply chain issues. And then what we're doing as far as upgrades is, I don't know if you're familiar with Fort Worth, but their Texas, Dallas area, the soil does move and their buildings do settle. So you got to make sure that you have good flat flooring. And so we had a few units we had to pump up the floor. The footings around the building were solid, hadn't moved, but the flooring internally had moved. So we had to push those up, make sure that that the floors are real level. The cabinets are, put new cabinets and countertops and backsplashes and matching appliances. We bought a C- property, and it'll be a solid C when we're done, but it'll look like a C+ with the quality of the work being done. It's pretty exciting to see the transformation there. And then we'll be able to push rents to market. They're quite a bit below market, up to $200 below market. So per unit times 152, that's a pretty good push. And that's only to market. And then, if you start adding amenities, maybe you can do more through RUBS or other reimbursement programs. So we're really excited about finding those kind of deals. And the 62 unit that we're going to contract on is a very similar story. It's a smaller building, but it's still very similar updates available. It's well run now and it's cash flowing, but it can be better.
So you mentioned earlier, you kind of alluded to nothing other than hard work in terms of the process of finding these deals. With something like a 62 unit, a little smaller community, are you finding those direct to seller through marketing or through brokers? How did that one land?
No, everything right now we're doing has been through brokers. We've done direct to owners on marketing, but we found our higher success with brokers. And it just seems like, especially in DFW, if it's under 150 units, it's going to be outside of the wheelhouse for or smaller, too small for the institutional and the Wall Street buyers. And there's so many properties there, so it's easy to get the right broker, the right deal. This one here, the broker actually called us and says, "Hey, I see you bought that other property in Stop 6 neighborhood. We got a similar vintage, similar type product. Wonder if you're interested." And we're buying it at less per unit and less per square foot than the one we bought already. And so we're pretty excited with the numbers. And it's also has an assumable Fannie Mae loan. So we're going to go through an assumption process on that to take over existing financing. And so super excited with that. But yeah, that was one, a broker actually reached out to us because we purchased another unit. We made offers there for 7 years with nothing, no acceptances, just across the board, just offer after offer after offer. And now we're getting our second, maybe third deal there in just 6 months. So it's pretty exciting to see that change. As you crack the market, people are like, "Oh, they're real. These are good buyers." So it helps. That's such a true phenomenon.
Our friend Michael Blanc talks about the law of the first deal. And while those aren't your first deals, they're your first deals in Dallas, Fort Worth. And like you said, people notice you do a deal or 2 or 3 deals in a market, and people notice you. They know you to be somebody that transacts, that closes deals, and you're going to be somebody that's on their list to call when they get properties. So that first deal, whether it's your first deal ever or your first deal in one market, is such an important one. It puts you on the map, really. And Bruce is a great example of what happens once you're on the map. People start, you start getting deals, and all that hard work starts to pay off, and it becomes residual almost in that, it's evergreen, right? Like, you've closed a deal, like nobody can take that away from you. So that's super exciting. Okay, so let me ask you: Are you guys syndicating? Are you raising private capital for these projects?
Some of each. The 152 unit we syndicated with another partner, a group out of Las Vegas came in, and they brought in most of the capital, and then we're the boots on the ground, so to speak. We're the the operator on the property level, and they're on the financial level. And so between the two of us, we raise the capital. But we do syndicate. That's not our strength. Our strength is finding deals, and then we partner with other syndicators, or that a smaller property we just take down, like the 36 unit in Albuquerque, we took down ourselves.
Yeah.
And so that's how we did that. But I'm hyper focused on acquisition, and hopefully I can find other people with access to capital. And another option we're looking at is finding some equity, Wall Street equity. Some of the when you get bigger, larger deals, where they're put, write I shouldn't say so big, but people that write under a $5 million equity check, there's not a lot of out there. They like the larger, they like the 10 million and up. But we're finding a few equity. They come in as it's kind of like a second loan, but Fannie and Freddie don't allow that unless you do a supplemental. So then we do equity comes in as they sit on the same side of the table as us, and they share in some of the upside. So that's kind of an exciting process that we're looking at. We haven't done one yet, but that's what we're looking at right now for our next deals.
So they're technically almost co-GP with you. That those equity sources. That's great. What's the nature of the firm that you did the 152 with? Did you say that they are fellow syndicators or capital raise? Like, what do they do specifically?
No, they're fellow syndicators. So they brought in, like I say, a bulk of the money and the equity through their syndications, and then they are co-GPs. They do the asset management on the financial level, and then we do asset management on the project level. So we're doing all the construction, managing the subs, getting the units updated, making trips there. I've made 5 trips to the property this year. Mm-hmm. Our project manager will be there. He's been there a few times. He'll be there again here probably next week or so to meet with the we got a loan for repairs, so we get draws, and the draw will he's got to go meet with the inspector from the lender so that they can offer the draw, to show what we did, what we've done there. And so we're very boots on the ground that way. I mean, not physically there, but we have people there, and then we make a lot of trips there. Somebody from the team is there almost every month.
I want to drill down on this partnership that you guys have with your fellow syndicators, because we're once again we're kind of in the same boat in that our team is very, very good at finding deals, broker relations. We get all our deals through brokers as well. We're good at due diligence. We're good at getting deals to the finish line. Our capital raising game is definitely coming along. It's not quite as well developed as our acquisitions game. So we're kind of like you, where that acquisitions really is our jam, so to speak. And for people like us, Bruce, doing what you've done with this other group, this syndication group that came in and raised most of the money, is a great way to get deals done, right? Like, there's listeners out there that are going, well, I got my head around going out and finding the deal and working with brokers or going direct to seller or whatever, but I don't quite have my head around this capital raising thing yet. I'd like to do something like what Bruce did. How did you meet those guys, and how did you go about kind of nurturing the relationship and getting the deal done?
So, that's great. So I had met one of the partners at I.M.N conferences across the country. I've seen him at quite a few of them, and he's got an accounting background, and he says, well, we also syndicate, we also raise capital, we have access to a lot of money. And so if you guys find a deal, we'd be interested in looking at it. So we sent them a deal in a couple of deals, and this one here, they just got excited about it because the numbers looked good. And they say, hey, we'd like to partner on that one. And so when we came in, now the biggest thing I can tell people is be very careful when you partner, make sure that the GPs are actually GPs. I know there's people out there that will partner with, will have co-GP, but yet all the person does is raise capital. And the SEC is not really excited about that. Right. If all you're doing is raising capital, they have to be actual partners and actually doing work. So we're very, very clear that there's shared responsibility, because
Right.
if they don't do any of the work, then they could be perceived as a broker dealer,
Yep.
and it could expose your syndication. So be very careful about partnering with capital raisers. It's better to partner with people that are going to be involved in the partnership, have regular calls. This group we partner with, they have a very strong finance background, and so they're able to make sure that on the balance sheet and on the rent roll and all that the expenses for repairing the property are below the line. They're capital expenditures, and they're not normal operating
Right.
expenses.
Super
And then
important.
also, yep. So they oversee that, and they also came in with liquidity and net worth, so we were able to buy a larger property. I've got a decent net worth for as far as the smaller projects we do, but my liquidity, I'm like a lot of investor and entrepreneurs, I keep very little money in the bank. It's always working, and banks want you to have this little slush fund sitting around waiting for them to know that you're a good borrower. So then
Right.
that's another reason you partners for liquidity. It's very important, at least for us. I don't keep a lot of liquidity individually, but collectively we do. With our group, we have a lot of liquidity, but my thing is to keep my money working.
Yeah.
And then the other thing is when you're partnering, it how the distributions are done, how the they manage the distributions on who gets paid when, as far as the fees and the profits to the investors. Like this property here, month 2, we had distributions. So July, August, September, right out of the gate, we get distributions, which is pretty exciting. And so they manage that, make sure that the investors get that, and that the checks or the ACH, however you do the transfers.
Mm-hmm.
And they manage the investor relations side. And then for us, we're all about the project side and make sure that division is good. I can't state that enough. I've seen other projects that people are doing, and clearly there's partners that are actually being broker dealers without a license. And it's just a very dicey place to be.
Yeah. Do you mind me asking about the structure on this setup with these guys? Is it like, was it like 50-50 kind of thing where they brought their set of activities and you brought yours, or some variation thereof?
Yeah, some variation of that. So there's they have 3 partners, we have 2. So then it was I'm the largest partner, but yet none of us have more than 50%.
Got it.
So we have to collaborate to approve things. Some things require 100%, some things require majority. It can be pretty complex, but like day-to-day stuff is, it's just this majority, just do it, let's get it done. But as far as disposition or any major decisions, we need be unanimous.
Yeah. Let's rewind for just a second for listeners. Important thing here. I asked Bruce where he met this partner, this partner that came along with net worth, liquidity, some money, some and capital that they were raising to do the deal, and also help manage the financial sides of the asset management. So super key part of getting that deal done. Couldn't have gotten it done without them or somebody like them. And Bruce, his response was, I met him at a conference. An I.M.N. What's an I.M.N. conference for listeners?
So IMN.org is an organization that puts together various conferences, and they have middle market multifamily conferences. They have single family. Right now, as we speak, they have a build to rent conference going on in Vegas, but they're 2-day conferences, and I speak at those on a regular basis. So if it's middle market multifamily in Texas, Arizona, or California, I'll speak at those events.
Okay.
And so then that's where you get to you gain some authority, if you will. I'm a small player. Some of those people that are in there have 10, 12, 15,000 units.
Right.
Some of them have 3-4 generations of wealth. It's a lot more legacy type ownership in the I.M.N. and not a ton of syndication. There's some, but syndication is an add-on to their core business. Feels like there's a lot more old money, generational wealth in this type of a conference than I've seen in some of the other ones. And there's nothing wrong with any business model. I just prefer the generational wealth as opposed to get in and get out and make a lot of money, because in reality, in real estate, in the last 10 years, anybody could make money, but how many people could build up wealth? And that's what we decided, we got to get some cash flow and get some regular. So that's the type of conference that is.
Yeah. And again, for listeners, these conferences are game changers. They're absolutely game changing potentially for you. They are the places that you're going to meet high level partners, investors, capital sources, really anything that you need to get a deal done is available. When you go to a conference and there's 100 or 300 people or 600 people there, everything that you need is in that room, in the way of your relationships with that group. And so getting to those conferences is massive, in my opinion. There's 3 conferences that I highly recommend going to, their annual conferences. If you guys want to email me, I'll send you a list of them. Tate at glequitygroup.com. And they're where, one of those conferences was where I met our partner Chelsea Garber, who has been a huge part of our team. And there were big things get done. And by big things, I mean big relationships get forged. And that's the key in this business. Is it's very, very relational. It's really not at all transactional. I wouldn't say not at all, but it certainly is much, much more relational than transactional. So my guess is, Bruce, are you guys talking with this group about doing other deals with them at this point?
Yeah, most likely we will do other deals. This one's pretty new. One of the partners I've known for quite a while, but the other 2 partners are new. So we, like any relationship, it's a dance in the beginning and learning to see who's doing what. And there's been, just to be vulnerable, and there's been tense moments, and then there's been really happy, exciting moments. But right now we're on a good trajectory. We have 93% occupied. They're happy with that, good cash flow. And then the projects since we bought it the last week of May, June is our first month. They've already turned 16, 17 units, and they'll get 6 more done the next week. So it's pretty exciting to see that. But just realize there's going to be, it's never all roses. If people say it is, it's just not real.
Yep.
There's always going to be the tense moments, but that's what creates friction creates traction. You can't have traction without friction. You can't have momentum without traction. So
right.
A little bit of friction. Now, if you have too much friction, you come to a standstill and you fight. I'm not talking about that. You don't want that much friction, but right. A little bit of friction creates traction. Traction creates momentum. I'm a big believer in being very open and free with people. So it's a long answer, but also as far as those conferences go, there's so many other things you meet there. There's lenders, there's other equity partners. There's, we underwrite our software. We use Red IQ for our underwriting tool, and it's absolutely phenomenal. It's a really powerful tool. We love it. It's online. You need a change, you can make changes. They're really supportive. So finding these type of things, it's so difficult to find that by just being online. And we went 2 years with no meetings, and things went online to Zoom conferences, and those were cumbersome. Losing connections. You couldn't really visit. So when the conferences opened back up, we were like, we're going, and so we've been attending. And it's been it's huge. Like you said, it's really, really powerful to meet people face to face. A lot of people go there to learn what's going on in the market. There's a little bit of that, but I think it's 80% networking and 20% new knowledge.
Learning. Yeah. So again, listeners, you got to be willing to go to these, in my opinion. That you're going to invest in a 2-3 day conference. You're going to invest a few grand in tuition to the conference and airfare and in lodging. And again, to me, there's 3 every year that are musts that I get to. And either, they're very high powered. There's a lot more than that that are multifamily specific conferences. So you'll want to really tune into those, what they offer, who's speaking, because the caliber of the speaker determines largely the caliber of the attendee. So, like I said, big people, big names, big forces in the industry hang out at these things, and it's your chance to go meet them and get to know them. So invest in those, invest in yourself, invest in your business, and invest in your business's relationships by getting to as many of these conferences as you can. All right. I'll get off my soapbox on that one. So Bruce, what's the future look like for you guys? Are you a team that has, big goals? Are you guys goal focused, or are you more kind of present moment, focusing on, one deal at a time, just doing good deals? How do you work as far as that goes?
No, we're very goal focused, and we have a goal for the end of the year on picking up units, and our goal is to replace all of our costs for running our business through cash flow alone. Right now, we get them through fees, acquisition fees, asset management fees, project management fees. So what I'd like to do is have less reliance on the fees and more on cash flow.
Mm-hmm.
So over the next couple of years, we're going to transition where we survive off of cash flow. We can potentially change the fee structure. I don't know that we would, because those fees are good for using for other acquisitions.
Yep.
And as well as down payments. You can't. It takes a lot of cash flow to be able to buy a property.
Mm-hmm.
With the down payment. So the fees would be used more for acquisition and growth as opposed to day-to-day operations. Right now, the fees are covering the overhead, and it's a slower growth that way in my mind than if we can have if cash flow covered everything, and then all of our expenses and the fees could finance our future. I think we'll have a really big growth, especially once the market softens here. The next 3 to 4 years, I think we're going to see some changes in the marketplace. Maybe not in Phoenix or Dallas as much as some areas, but we're going to see some opportunities pop up in the Southwest. In my mind, things are way too tight as far as margins. People are not underwriting enough expenses. Income's going up, everything's going up, and I look at their expenses. Now I'm starting to see other people including expenses, but 6 months ago, they were putting expenses from 2 years ago. I was like, no, your expenses have gone up 30%. Inflation's huge. Lumber's expensive. Labor's going up. So we're going to have to pay for that somewhere. So people need to really look at what is their expense ratio, what is expense per unit, and make sure that they're in market, because expenses will kill your model.
Yeah.
But there'll be some opportunities coming, I think. And, 2025 is kind of what I envision. We'll start seeing some good opportunities come. And that's not advice. That's an opinion.
What I'm curious, why 2025? Is it just the cycle that you're seeing, or?
Yeah, we always in 200 years we followed a 18 year land cycle, and the land cycle is what determines the price of your property. It's the land underneath it that has the value. So if you have a 200 unit building in Salt Lake City, a 200 unit building in a Bullhead City, a 200 unit building in Dallas, a 200 unit building in Waco, they all have different prices, even if it's the exact same building. Why? It's the land underneath. Well, we haven't seen land prices spike quite yet. I mean, we've seen some big growth, but remember the last cycle where the land spikes last? So it's the last thing to raise, and it's the first thing to crash. So the first houses will go up, and then condo prices start to skyrocket, and then land prices. And then when it starts to fall, the land prices will go first, and then condos, and then single family. So that's the lion's share of home ownership side. But the real estate, but the multifamily will also be affected by that. It's going to be slightly different than the houses, but we will see where land prices push so high that it makes sense to get a really good deal on an occupied building, tear the building down and rebuild it. We're seeing some of that gentrification, but we'll see more of that before we see a big pullback. But it's cyclical. It has been for 200 years. The studies I've done, and again, those are all opinions. I've not, if anybody's looking for advice, I don't have enough letters after my name. All of mine has been studying of market cycles and the Federal Reserve and how they fund the market, and how the bond market. I mean, there's so many things that tie into the real estate, but we have too many fundamentals right now that are still strong. So we have a pullback right now, but what, 10-15% maybe off the peak, and it'll stay there probably till March, April, and then it'll pick up again, I think, next summer. And we'll have a spike in 2024 is my estimation. And again, it's just an estimation. Whether if I'm wrong, I'm still protected. That's what I'm looking at.
Right.
So are the investors.
Back to that. I mean, it's so fundamentally key and important right now, in my opinion, to be protected. And to be protected means to be doing good, solid cash flowing deals on longer term fixed rate debt, and be ready to hang on for the duration, so to speak.
We're even looking for HUD finance. We're gonna start pursuing some HUD financing, which is a 30-year mortgage amortized over 30 years with no call. That's a legacy product right there, and they have some really good rates right now. It takes 6 to 9 months to get your first deal through their system. It's all asset based, so you won't do it on a purchase. That's not going to happen, but you can do it on a refi. And so that's one way to protect, as long as you can cover your mortgage by a sizable amount. Not 1.2. I'm talking 1.5, 1.6. You'll be really safe in your debt coverage ratio.
Mm-hmm.
And then you can weather the storms. And if the market goes soft, you're like, that's okay.
Right.
We've got good debt.
Right.
But if you have to sell and the market is falling, it's very, very emotionally difficult to sell in a falling market, especially if you're required to based on a loan being due.
Right.
And you're trying to go get a refinance. I've been down that road in 2008. It was really difficult years. We took some arrows in the assets and regrouped. Actually, 2000. I was a slow learner. I figured it out in 2011 that we had actually bottomed out in 2012, 13, 14 with good years and growth. But it was a really difficult time to go through that. Yeah. I don't want to go through that again.
Yeah. Yeah. I mean, it's nice to be talking to somebody that's been through a downturn in the market. It's kind of rare on the show. There's so many younger entrepreneurs in this space and people that have been in W-2 jobs their whole life that have come over into the space. And so there's a lot of, a high percentage of the guests that I've had on the show, haven't seen a market downturn like what we saw in 07, 08, 09. And, you've been there, Bruce. So you're seasoned, the game, how things can happen and how things can go. We're clearly not poised for something like 07, 08, as far as the bottom falling out of the market and lending being the primary cause of it. For the most part, everybody's still doing good loans and not doing, no doc type loans like what we had before.
No, it'll be something different. But we have a lot of cash in the market too. There's a lot of people with a lot of money, a lot of businesses with money. So there's still a lot of capital, that's liquidity that's out there. And that when you hear that liquidity is out there, that's always healthy. Even Wall Street, when they pulled back, some of the REITs and some of the institutional buyers put the brakes on when the rates went up, earlier in the summer. And still, people are worried. Well, they're shutting. It's like, no, that's good. They have liquidity, because as long as there's liquidity in the market, there's some safety. It's when you lose that liquidity, or they say, hey, we're moving out of real estate, we're going into silver or gold or something else, then you start saying, wait, what's going on? Where's the big money going? But they're still staying in real estate, and there's a lot of healthy liquidity. So that's why I think we have some years left. The other thing I'd advise people, I've been through a cycle, but talk to people that have been through more than you have. My mentor has 53 years experience in real estate and manages a few $1 billion in assets through their funds. And he's been a local guy here and very humble guy. And he's been involved in the business. He's semi-retired, but he's still involved. But I have regular calls with him. I have one again tomorrow with him, and just talk to him. Well, what's going on in the market? What do you see? What should I do? So don't go alone. Never, ever, ever do this alone. There are people that have been in this business longer than you have, longer than I have. And if you can tap into somebody's mind like that, it is so powerful, Tate. It's just unreal how much knowledge you can gather from somebody that, I'm 53 years old. He's got as many years experience as I am old. And in real estate, multifamily, that's pretty impressive.
That's very, very impressive. Yeah. You don't hear about that kind of track record very often. How did you come about that relationship with your mentor?
Actually, it was my brother works for a construction company, and they do the remodeling on their apartments. And so he introduced me, and we went out to breakfast, and we just became friends. And it's been like just a total open door. It's really amazing that he's willing to share. And I tried to get him on a podcast. He said, "No, I'm just friends with you. I don't go on other people's podcasts. I'm not interested." He's really under the radar guy. If you met him, you'd never know how successful he is. He's so humble.
I like it.
It's pretty impressive. So yeah, I was just through my little brother said, "Hey, you got to meet this guy. He's in apartments too." And I said, "Okay, I'll meet him." And there we go.
Yeah. I mean, that's a gift, man. A relationship like that is a true blessing. And, I frequently recommend that listeners consider doing paid mentorships or paid coaching or paid masterminds, because you're guaranteed to get the level of commitment and engagement and availability that you need. But Bruce, for you to kind of organically discover and nurture that relationship is that doesn't happen every day. It doesn't happen to every investor. So that's very fortunate for you. I'm super glad that that's worked out well for you. There's nothing like the power of a good mentor, like you said.
No, thank you. It is good. And I do also have a paid mentorship group that I'm part of. We do 4 meetings a year with other, there's 2 groups, cash flow, and then there's single family, and we able to network together. So it's, I'm all for getting out there and continue education, mentorship, paying for things. One of the things that I believe in is if you want to make $1 million more next year, you have to spend $100,000 in commitments and learning
10%.
and networking and traveling. 10%.
Yep.
If you want to make 10 million, you got to find $1 million.
Yep.
And if you think you can do it all organically, only a very, very few people are able to do that. But if you want to fast track it, give 10% of your income towards education and continued networking, and it'll pay dividends.
Yeah, I've heard that rule of thumb as well, that 10% of your income should go towards improving yourself, improving your knowledge, your skill set, your specialized knowledge of the industry, of your markets, et cetera. It's key. And again, your competition's doing it. So you need to know about it, and you need to likely do it yourself to be competitive and to make the impact you're trying to make. Well, Bruce, to kind of start to bring this full circle here, with all of your experience and all of your gray beard and all the units you've done, and what would you say to an aspiring investor who is, let's say they're looking at they've done some single family, they're looking at scaling into multifamily. In that transition, what do you think are, what do you think are the key things, or a key thing to kind of keep in mind for that transition?
Oh, very simply, do not do it alone. That's a whole nother show. Somebody else already used the tagline, ask me how I know. But you don't want to do it alone. I've tried that, and it's very, very painful. If I'd listened to the people that were around me and had around me, I wouldn't have had as many losses and as many struggles as we did along the way. So those are very expensive lessons. The good news is we've learned. So now always scale up if you can. Do not be the smartest person in the room.
There you go.
Do not do it alone.
Yeah, such wise words. Teamwork makes the dream work here, and it is a team sport. So if you're a solopreneur, another model might work well for you. But in this space, almost everybody does partnerships. That's just the way things get done. So, well, Bruce, this has been awesome, man. I really appreciate the chat and all the things that you shared, and I'm super excited for all your success, and you guys kind of cracking the nut in Dallas Fort Worth and getting going in that mega market. It's like the 3rd biggest city in the country right now, after New York and Chicago.
8 million people in the metropolitan area. It's almost 8 million people. It's huge.
Yeah,
metro.
Yeah.
It's absolutely huge.
Yeah. So, so I certainly, we're certainly rooting for you. If there's anything ever that we can do for you guys at Greenlight, we'd love to be helpful. For listeners that are interested in reaching out and touching base with you and kind of learning more, what's the best way for listeners to reach you?
Oh, very simple. Go to bakerson.com. That's BAKERSON.com. Scroll down there. You can get right on my calendar. You get right to go to link you to Calendly.
Yep.
Which is a hard word for me to say for some reason today. Calendly. But go there and get on my calendar.
There you go. There you go, listeners. And you can do that on my website with me as well. If you want to reach out to either one of us, we're here for you guys. And we mean that. Like, we're not just saying that. It's, We love to talk, to share, to network, to collaborate. And that's how you do it is reach out. So, if you think you've been proactive by listening to a podcast here, take the next step and reach out to one of us and set an appointment. My website's investwithgreenlight.com. Bruce's is bakerson.com, BAKEROSON. Sorry, BAKERSON.com. And take advantage of these connections that are available to you. So Bruce, thanks again. This has been great. Loved having you on the show, and certainly wish you all the best.
Hey, thanks for having me on. It's really been a joy to be on your show, and hopefully somebody pulls one little nugget out that they can use to their business.
That's it. I mean, if you guys get one, maybe 2 or 3 takeaways, that's what it's all about. So right. Listeners, thank you for listening to another episode of the Apartment Gurus. As you guys probably know by now, we're doing 2 of these a week now. And so we've really geared up, and we're coming at you every few days. So we'll see you shortly, and on the Apartment Gurus podcast. Thanks again, everybody.
This has been the Apartment Gurus with Tate Siemer. If you enjoyed this episode, be sure to subscribe and leave a rating and review on your favorite podcast platform. To contact Tate, go to www.investwithgreenlight.com for access to his investor portal and Calendly link. He loves to hear from you and thanks you for being a valued listener. Just a reminder that you are the guru. See you on the next episode of the Apartment Gurus.